Hi ladies and gents, welcome to a quick podcast where I'm going to be looking at depreciation, disposal, and more importantly here, and this is something students do find difficult, where we've got to do part year depreciation. So it's where the depreciation policy isn't either a full year's depreciation in the year of disposal, year of purchase, and none in the year of disposal, or potentially you could do a full year's depreciation in both the year of purchase and the year of disposal. Okay, how does it work? I'm going to do two things. I'm going to do a worked example using reducing balance. First of all, I'm going to look at how it works with a straight line, and then the example that you're going to have a go at is actually a straight line one, which is relatively easy. Obviously, reducing balance tends to be a little bit more difficult. When you're doing your example, don't forget to fill in the assessment as to how well you think you can do. So let's fire away. Okay. So what we're going to be looking at is not where we do a full year in the year of purchase and on the year of disposal, or full year in year of purchase and in the year of disposal. We're going to be looking at where depreciation is calculated from the date of purchase. So if equipment was purchased 7 months into the year, there are 5 months left over. So we provide 5/12 of a full year's depreciation. In that case, the equipment was sold 5 months into the year, then we would put into the accounts 5/12 or 5 parts of a whole year. That's 12 months in a year. It's depreciation. So, business owned a motor vehicle that cost $10,000 and was sold on the 1st of April 2015. During the year, the business also purchased a new motor vehicle on the 1st of Feb 2015 for $12,000. Year end at the end of the year, and we're going to do 20% straight line depreciation. So on the vehicle that we disposed of it on the 1st of April, so we need to include a whole month's depreciation for January, February and March. So we do 10,000 times 20%, which equals 2,000. Then we multiply that by 3/12 of a year, and that gives us $500 depreciation needs to be provided for vehicle 1 in this year. Vehicle 2 was the one that we purchased on the 1st of Feb, so we owned it for the whole of February, March, April, May, June, July, August, September, October, November and December in the year, so that's 11/12. So we need to do 12,000 times 20%, which is 2,400. divided by 12 to find out how much depreciation we need to provide for each month, and then multiply it by 11, and that gives us 5,700 depreciation for the whole year. So worked example, so that you know what we're actually doing, is this one here. Okay, business started to operate on the 1st of April 2013. Purchased a delivery van for $20,000 on that date and decided to adopt the reducing balance method and using 50% on the time apportion method. So that means for each part of a year that it's actually owned. And the business year end is 31st of March. On the 1st of July 2014, they purchased a second delivery vehicle for $30,000, and on the 1st of April 2015, they part exchanged a vehicle purchased on the 1st of April for a new vehicle costing $40,000, and the value placed of the old vehicle was $6,000. First of all, make sure you get the easy marks in the exam. The easy marks are doing the motor vehicle account. So, first vehicle purchase, $20,000. Okay, balance brought forward at the start of the second year is $20,000, but then they purchased a second vehicle for $30,000. So the total carried forward will be $50,000, the value of the two vehicles. And then in the second year, you've got a balance brought forward of $50,000 and $20,000 going to the disposal account. And then we'll look at this in a bit more detail, but we need to also increase the debit side of the motor vehicle by $40,000 for the new vehicle purchase. But I'll explain why we've got bank and disposal in there in a moment. Right, what I would then do before I even started to do the provision for depreciation account, I would work through and I would actually do the depreciation for each year for each vehicle and do them all separately. So in the first year, just make those orange so you're going to focus on the right things. First year, we had a vehicle that cost 20,000. We're going to do 50% reducing balance depreciation. So we do 50% times 12 twelfths because it's a whole year, or just multiplied by 1. So the depreciation in year 1 is 10,000. The carrying amount is 10,000. Looking at year 2, therefore, the opening carrying amount will be 10,000 for that vehicle. We owned it again for the whole year. Therefore, the depreciation for that vehicle in year 2 would be 5,000, and the closing carrying amount will be $5,000. And then for year 3 is a little bit different. We've got an opening carrying amount of 5,000. Times that by 50% would be 2,500, but we only owned it for 6 months. So divide 2,500 by 12 and multiply it by 6, or times it by a half, gives us a depreciation for the year as 1,250. And then we don't need to work out the closing carrying amount because we know it's going to be sold. Vehicle B. Okay, vehicle B bought for 30,000. Okay, during the year, 50% straight reducing balance, but we owned it for 9 of the 12 months. So 3 quarters, all times that by 9 twelfths, comes to 11,250. Therefore, the closing carrying amount is 18,750. So starting our calculations for year 3, 18,750 times 50% times 1, or times divide by 12 and multiply by 12 because we owned it for all 12 months, gives us a depreciation of $9,375 and a closing carrying amount of $9,375. And then vehicle C was bought for 40,000. It was owned for half a year, so 50% is a depreciation, but we need to then times that by, or divide that by 12 for 12 months and times it by 6, the months of ownership. And that means that we've got depreciation for the year of 10,000 and a closing carrying amount of 30,000. Right, the depreciation account then is relatively simple because we've only got one vehicle in year 1. The depreciation is 10,000. Balance carry forward of 10,000, balance brought forward of 10,000. In year 2, we've got 5,000 depreciation for vehicle A and also 11,250 for vehicle B. So we've got $16,250 worth of depreciation added. So the total at the end of the year is 26,250. Year 3, slightly more complicated because we've now got 1,250's worth of depreciation, add 9,375 and add another 10,000. So the total depreciation for year 3 should be, sorry, I've just lost it, 20,625. But what we also need to remember now is what we're going to do with the disposal account. If you've laid out your workings the way that I've done, then this is quite easy because we know that in the first year for vehicle A that we disposed of, we had $10,000 worth of depreciation. We added 5 and then 1,250. So we're going to transfer to the disposal account a total of $16,250 worth of depreciation. Closing balance, 30,625. Okay, and then in the disposal account, we've got the vehicle we disposed of. We've got the depreciation, which is 16,250. We had a trade-in value, so the value on the vehicle that we disposed of was $6,000. So I've credited that to the disposal account, debited it to the motor vehicles account, and then that gives us a debit entry in the disposal account of 2,250. So we need to add that on to our gross profit in the income statement. Very quickly up there, you can also see the statements of financial positions for each year. Right, I've got the question for you to do. The question for you to do is actually a straight line one, so it should be more simple. Good luck.